Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So we've collected $3.30, but we have one naked call option that could pose a problem if the pair value starts to take off in our anticipated direction. So the solution, again, is that we're going to create a bull call spread. So we're going to take that total credit of $3.30 from the sale of our two June 75.5 calls, and we're going to buy one June 70.5 call at $4.30. So we're actually going to have to put an additional $1 into this position, which is something that I don't like to do. But so you have to always measure your your risk versus reward scenario. The ideal situation is being able to do this without having to put up any additional cost. But ultimately, by doing this, what we've done is we've created a position now where we're long our 70.5 call, which cost us $4.30, but we're able to use the credit that we received back for the original position of $1.65 plus the one that we received from selling naked to create a short position for one 75.5 call. Now, again, remember that what we've done to achieve that 3.30 credit or $3.30 credit to our account is that we've added the $1.65 each for each position to come up with that, and there you have your bull call spread. Now, the total cost of that spread is going to be $1. We're putting an additional $1. Our new position now is that we can profit from any rally off of our support level at 72.50. So if we find support at that 72.5 level, okay, we can profit as the EUI turns around and bounces off of that. Now, our maximum profit potential is the difference between the two strike prices. Unfortunately, for some reason, we can't see the left side of the screen here, but we're short the 75.5 strike. We're long the 70.5 strike, which means that we have a profit potential of $5. The distance between or 5 points, so the difference between the two strikes. Okay. The initial cost of our trade was $3. Remember that the 75.5 initial call option costs us $3. We've added an additional $1 for the spread, so that our total sunk cost is $4 for that position. Okay, our maximum profit is if the EUI is at or above 75.5. Okay, which means that we can actually make $1 or up to 25% if over the life cycle of those option contracts we do happen to get a move in the underlying pair value above that 75 strike. If we look at it from a price chart perspective, here's the support level that we've established for our position here, and recognize that this is the line in the sand regardless of what type of strategy we've created, because our anticipation is that if the EUI drops below that, then high probability we're going to come down and likely test some of these lower levels. But if we just happen to get a little bit of a detour, we're going to be at roughly a 50% loss here, but that doesn't mean that we may not get a bounce and a little push back above this. So the idea of creating this strategy is just repositioning ourselves in such a way that we're selling that original 75.5 call, which, remember, puts our break-even point way up here. So that means that if we kept just that original 75.5 call and we were taken on a detour, okay, not only would the EUI have moved all the way down to the support level, but it would have to rally back up and up into this 78.5 level for us just to break even. Okay, by re-establishing ourselves within this trade by creating a bull call spread, Okay, what we've done is we've recognized that, hey, we may hold support here at 72.5. So we're going to sell that original position for what we can get for it. In this case, the example was $1.65. We're then going to go in and we're going to simultaneously sell another $75.50, collect another $1.65, and then buy. Let me just clear these annotations out of here if I can. Bear with me, guys.
Hey, Jace?
Yep.
I had a message, and I guess one of the attendees said, shouldn't you consider your loss on the first trade, which seems to make sense to me also.
Yeah, absolutely. I mean, absolutely. There's no question about that. You know, from my approach, I am more of an individual where I trade straight puts and straight calls. If I'm on the wrong side of it, I'm on the wrong side of it, and I want to admit that. But as I said, my initial line in the sand is going to be that 50%. So with this type of scenario, as I was mentioning, if the possibility of this support holding is strong, and this is something that you've anticipated, and you're still above that 50% threshold, then by repositioning down here at a lower strike, you're still not sacrificing or risking any more than what you would originally. What you're doing essentially is you're lowering your break-even point. So with the straight call, I'm at roughly a 47% loss, and I'm down here at support. And recognizing that in order for me to break even, the pair value has to be all the way up here. What I can do is reposition myself, and essentially for the same risk, I can put myself in a position where if we happen to get a bounce back up to test this level here, I might actually make some money and at the very least get my premium back to say, okay, you know what, that was not a good trade, but at least I'm able to get out with the premium that I've put into the position. So I think in that respect it makes sense. Now at the end of the day, if it breaks this line here, then you know that's that hard and fast rule where if it breaks support, you've got to cut your losses, because you know you will have sunk in total to this trade $4, and if you let this option contract, if you let this yeah, that's exactly Bruce's comment. Isn't your new risk $4? It is. There's no question about it. So you've raised your risk exposure from $3 to $4. But again, you have the ability to get out if it starts to break below this. And remember, you've got a 70.5 option contract here that you've bought. And if we're at 72.5, recognize that the intrinsic value of that premium is going to be $2. So you'll be, as long as your pair value is above that 70 or at that 72.5, the amount that you're going to get out of that on expiration is still going to be your intrinsic value. And this is a strategy that needs to be thought through. So this is an example. It's an alternative that one might look at if you're looking to you know, step in and manage a position. But at the end of the day, it may not necessarily be the most appropriate one for the trade that you're in. What the point that I want to get across is that you can conceivably reposition yourself. And again, by creating that spread, what you've done is you've ultimately, yes, your break even is on the trade is $4, but now all you need to see is a rally back up to where you got in to break even versus above that 78.5, which may not you may not have enough time allocated to do that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.